Hang Seng is up 1.9%.
Nifty need to trade and close above the 40-day exponential moving average.
For FY23 numbers, top line growth came in at 4%.
First tick on the index is in the green, 60 points higher.
Don't believe that companies putting billions of dollars into EV are adding anything to the industry.
We just need to make sure U.S. doesn't depend completely on other countries.
The regulator SEBI has advised the company to keep the implementation of new platform in abeyance.
The MD has resigned with effect from 15 December, and in the interim, Vishal Mafatlal will steer the operations of the company.
And over the past 3 months, the IT index has outperformed the banks by nearly 9%.
Ashok doesn't have any fixed time frame within which it comes down to 40%.
And mid-caps are definitely doing very well today, so we have that index higher by 1.3%.
Well, that was a day so far. You're with us here on a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Rima is here. Rima, hi. Good afternoon.
Hi. The last trading hour before the long weekend. All set?
What plans, Rima?
I'm here.
Yeah, Bombay?
Bombay.
Okay, well, the market's doing just fine. It's a strong day. But, just look at the last 3 days, right? Day before yesterday, we had that big rebound from the day's low. Yesterday, there was no follow-through. There was a massive sell-down of 200 points from the day's high. And today, we have almost a 200-point bounce. So, tough to kind of make a sense of it. We're basically back where we were above 19,700 around the same time yesterday after the bounce that we've seen. So, it's been steady through the course of the day. I think that much is for sure. Just a few levels. The 40-day, we are above the 40-day exponential moving average, which is at 19,624. So there is some distance between that and where we are at right now. That is good. That's great news. Bank Nifty was the weaker of the two indices. That had broken through all supports. Forget the daily moving averages. As of yesterday's close, it had broken below the 20-week moving average as well. And today it has climbed back above it. Again, good news. So that is at 44,570 as of yesterday's close. And we are well past 44,700. Mid caps and small caps, of course, they're doing very well, 1% each. It's again, I think, going back to what's happening in the US later. So yesterday, of course, we woke up to better cues, which is yields, dollar, oil, all down. And I think continuation will be important when we come back next week. Of course, US will be trading, but we've got Monday as a holiday. Today, later in the US, we'll also get the US PCE inflation data, which is watched pretty closely. So that is important. And remember, there is that small issue of government shutdown in the US, right? Yeah. And the deadline still is looming.
It is Sunday, 12 o'clock. That's the 1st of October. Will they not? In the past, I think there have been about 20 instances since 1981 where the government is shut down. Typically, the duration is not much, 1 day, 3 days. But there have been, I think the longest one was, 5 years back when the US government had shut down for 35 days. And while it's not, in the past at least, had a big impact on equity markets, there are other implications. For instance, the CPI data, which is expected sometime in October, that might get delayed. The labor data gets delayed. Then it feeds into the FOMC meeting. So, it could affect the way the Fed looks at, the upcoming policy decision. But anyway, back to our own markets. Look at the way so many of these indices are doing well. Pharma index, the FMCG index, even IT. IT, which opened with a cut of 1%, has recovered. It's off 1.5% from the day's low, and the IT index is too back in the green. About those US macros, the improvement has actually continued. The US 10-year yield yesterday closed at 4.57. Now it's at 4.54. The dollar index, which was above 106 yesterday, is now at 105.7. So there is that improvement there as well. And the Dow futures is currently up close to about 150 points. Hi, Sonia.
Hi, afternoon. It's turning out to be a pretty good Friday, right? For the bulls, that is. And we'll end up pretty strong for the week as well. So lots to watch out for. So I guess we'll just start off the show. How should you position yourself in this last hour of trade? Mitesh Thakkar joins in now with some closing strategies. Mitesh, hi, afternoon. What are you looking at? Because now we've almost, we have conquered that 19,700 mark. Are we good to go for more? And what is the strategy at this point?
Good afternoon. I think, first in the morning, if you would have asked me, we'll see 190-point uptick, I think I would have clearly said a strong no. This is much more stronger than I suspected. But a couple of observations. One, I think, we've maintained that the index will see some kind of a reversal above 19,750. So I think let's cross that level. One. And two, I think during the day, obviously, as the stocks have started to make new highs, the sectoral indices that you're pointing out were breaking out. I think we've kept on adding on to long positions. So I think the directional call on the stock is on the long side. But on the Nifty per se, if I was to trade now and want to initiate a trade now, then I think I would wait for 19,750 to be taken out. Or there might be one more leg of a 50 to about 100 point kind of a decline, which would be a better entry point. As I was mentioning, I think the hourly charts, which were expanding on the negative side, that expansion has ended with this kind of a rally. So I think at least one, we are now safe in the knowledge that we might not fall immediately. Two, I think once we start getting past 19,750, I think we'll see good strength on the upside. So right now I have two buy calls. Gas Authority, GAIL, that's reversing nicely after a few days of pullback. So buy here with a stop at about 122.5. Look for targets of around 130. And Grasim also, I think the long-term charts are very good over here. Grasim is a buy with a stop at about 1920 for targets of 2015.
Okay, no risk of immediate kind of faltering, but about 19,750. Mitesh is saying we'll get a better sense, a better handle of what the market wants to do from here. Well, Hindustan Zinc and Vedanta shares are surging. So Vedanta, Hindustan Zinc earlier approved a corporate restructuring to unlock shareholder value. This is, of course, and there were reports earlier that Vedanta perhaps will do something similar as well for its, 4-5 businesses. But we are yet to hear on Vedanta. Vivek is here with more on this story. Vivek.
Well, that's right. So both Vedanta as well as Hindustan Zinc today are in focus. Both of the stocks are doing quite well in the session. Now, the reason for that is that Hindustan Zinc has given an announcement to the exchanges where they have said that they have appointed a committee of directors to evaluate corporate restructuring, and the company is looking to go ahead and create separate entities for the zinc business, the lead business, the silver, as well as the recycling business. They will also appoint external advisors to evaluate restructuring. How does this impact Vedanta? Remember, Vedanta holds nearly 65% stake as far as Hindustan Zinc is concerned. It's also important to note that the government also holds a significant stake, and all of the decisions that the management does take will actually require the shareholder approval as well as the government approval. Now, this comes in context given the fact on September 26th, Vedanta, having significant cash flow mismatch problems in terms of actually having to repay its debt, did see a ratings downgrade coming in for the parent entity, that is Vedanta Resources. So Moody's downgraded the corporate rating of Vedanta Resources on September 26th. Moody's has said that the downgrade reflects the elevated risk of debt restructuring over the next few months. Now, along with that, yesterday, a whole host of reports, we also reached out to the management. We are yet to receive a response from them. But reports have indicated that similar to what Hindustan Zinc has done, Vedanta too is looking to demerge all of the separate businesses that it has into separate entities so that they could go ahead and unlock value. Now, this move is part of the broader restructuring plan that the entire group is doing. Now, why is all of this important? Remember, Vedanta has significant debt issues. So Vedanta Resources, according to Citi, can meet all of the debt restructuring or debt repayment obligations that it has for FY24. But the problem arises in terms of the company having the cash flow to go ahead and actually meet its FY25 debt obligations. They're saying the pure dividend upstreaming from Hindustan Zinc, Vedanta earnings, as well as brand free at this point of time will actually be inadequate to meet the FY25 obligations. What is the quantum of debt? The repayments and interest due in FY25 are close to $4 billion.
Okay. Got that, Vivek. Thanks very much for that. So FY24 perhaps, yes, but FY25 is the problem. Rahul Jain is joining us now. He tracks the metal space closely. We also have Prakash Diwan joining in. Gentlemen, good to have both of you here. Rahul, let me come to you. So, as Vivek said, there is Hindustan Zinc, of course, which has been announced. There is Vedanta, which perhaps is expected to do something similar. The various aluminum and oil and other businesses, which it merged at one point years ago, it perhaps will sort of again demerge. But does it solve? But all of this will take time, right? There are regulatory approvals, shareholder approvals, all of this. Does it solve for the near-term liquidity challenges? How should one look at this? If Vedanta were also to do it, let's assume, along with Hindustan Zinc, Vedanta is also doing this.
So first I'll start with Hindustan Zinc. So for example, to break up is quite difficult because a lot of these businesses are interlinked. The silver production is largely through the lead production. So it looks very difficult, as to how you can separate these businesses. And the balance sheet on Hindustan Zinc is really not a problem. There is debt and there is equal amount of cash. And they generating a decent amount of cash because it's largely integrated operation. Now coming to Vedanta, the debt has gone up over the last several quarters, largely because of the very high dividend payments. Now, the dividend payout has been compulsion is obviously the debt repayment obligation which the parent has. And so although they have been saying that a lot of these issues are temporary and things will get resolved, but obviously there is a concern in the market that these things can take time to play out. So those issues are there. Now, obviously, this step which they have announced for Hindustan Zinc doesn't seem to be that, it can be implemented in a hurry. Key issue also is the government holds a significant stake in that company, and the first step ideally should be to get the government out, by through whatever acquisition, through the acquisition, and then you can pursue the other plans which they already had, for example, to merge the South African zinc operations with Hindustan Zinc. I think that would be a better thing to work rather than to separate Hindustan Zinc initially.
Rahul, markets price future events today, right? We have to find the net present value of a future event. So already the stocks have reacted positively, but what would you ascribe the increased valuation on the back of this corporate restructuring for Hindustan Zinc and even for Vedanta?
Hindustan Zinc kind of has actually stagnated as a company. If you see, the production growth has been quite muted over the last few years. Another big challenge for the company is that they are not investing a lot into the mining operations because they have a deadline of 2030 for when the mines go back to auction again. So obviously you don't take a very large investment risk when you are not really sure whether you have a mine life beyond that 2030. Obviously, there will be prime contenders to get it. And for the Vedanta businesses, Vedanta is an agglomeration of several businesses, largely zinc and aluminium, and some amount of copper as well as crude oil. So these 3-4 are the key segments. Now, what has happened is the debt going up, you definitely increase the riskiness. So obviously, there is a section of investors who don't want to play such a high risk play. But if you look at the overall commodities play, so I particularly think that there is a commodity super cycle due over the next several years because so in that case, Vedanta is a very strong contender in that segment, and the aluminium piece has done really well over the years. And that if at all they are able to succeed, if they're successful in going ahead with demerger plan, the aluminium piece will be very interesting to look at. They have got several large coal mines coming into operation. They will be fully integrated on that. So I think market reactions are short term, very difficult to predict which way to go. But as a company, they are a cost leader, and their balance sheet issues appear to be temporary.
Okay. Prakash Diwan, I wanted your thoughts on this because, the problem with Vedanta for a very long time has been the escalating debt, right? I mean, as we speak as well, I think the debt that Vedanta is sitting on, gross debt, is almost $6.5 billion. And we've seen that play out in the stock as well. I mean, the stock has sort of fallen off a cliff in the last 6 months. It's down almost 20%. As and when this corporate restructuring fructifies, what should Vedanta shareholders do?
So that's a very valid question because we've seen the stock also have some sort of a silver lining given the fact that Vedanta was shoring up its own resources and the Indian business actually threw up a lot of cash as dividend. So people have enjoyed that, those 1.5, 2 years of a phase. But now is the time where, it's trial by fire. And whatever restructuring that they undertake is right now going to be more of, an indicative trend of what's likely to come in terms of unlocking value. I mean, these are all companies like Sterlite Copper, Kane, Setsago, all of them coming together now. You're demerging these businesses. So there could be some value unlocking, but I'm not too sure whether that's going to be so exciting. Of that demerger to come through maybe later in the day. Essentially, what shareholders should do, if you have to play commodities, it's definitely a very good bet. I think it's too big to fail in most of the businesses that they are in. And commodities is, as Rahul very rightly said, in a super cycle, which could probably be very secular and long term. So they will find a way out of this FY25 mess, which seems to be a bigger challenge than FY24 repayments. So there could be some respite. But yeah, it's a mercurial stock, hasn't been very consistent, so not for the faint-hearted. And then it's best to kind of take tactical move, plays out there, not something very long term.
One has the stock and is sitting on losses. My question is not for fresh purchases. If someone's sitting on losses, should you book out now or should you just keep the faith?
No, so that's important, Sonia, that if you have it and you're not getting your value, you will have to definitely wait. For the simple reason, there could be, if there is a possibility of improvement, it's on the way up. Because they will want to do things which create value so that they can benefit. The parent company with Vedanta Resources has to get bailed out. So that will not happen if this business kind of suffers. So I'm sure there's some sort of a linearity to the improvement that can happen. And people could probably start seeing some value getting created in the near term as well.
Rahul, what would your kind of advice in that sense be? Would you be a buyer? Because the underlying businesses are all doing well because commodity prices are well and they're projected to do well. It's a very profitable business. The problem is at the promoter entity, not with Vedanta Limited itself, but it's a problem nevertheless, and that depresses the price here. It should not be trading where it is, had it not been for the debt problems at resources level.
Prakash rightly said that dividends have been fantastic over the last 2 years. Obviously, that won't continue in the near future, given the debt which has gone up significantly. So you should look at it this way: you have businesses which are world class, which are delivering a decent amount of growth. Obviously, there is a volatility of the commodity price. So we had a huge, sharp jump in last year, especially after the Russia issue. That has now subsided, and commodity prices are at the normalized levels. And there's also a huge, the underlying currency benefits. There is a huge integration which is happening. So in terms of earnings, I don't see a lot of disappointment. It's largely coming from the balance sheet side. And there is a concern what will happen next year, debt repayment. But they have somehow managed over the last several years, and I think they will definitely manage going forward. So obviously there is a high volatility in the stock, but it's definitely a very long play, in terms of the quality of assets. So it's a very long run play on the domestic India play in a way, you can look at it that way.
But will it make money? Will the share make money from here? The price is still Vedanta share price is where it was in 2009. Lots of swings in between. Yeah.
So you see, these commodities typically you look at them on EV, EBITDA kind of a multiple basis. So of late, because of the cash drain, the EBITDA has certainly not got impacted. It's the EV which is mix which has changed. And over time, as you generate more cash, the debt comes down. You will see an equity return coming back. So and plus they've had setbacks, in the past with respect to the cane not performing as expected, and then coal mines also not getting allotted. The alumina mines also, for bauxite not getting allotted. Now all those things are falling in place now. So obviously at such stressful times, you get the stock cheap, but you'll have to go through the uncertainties with respect to debt. Now, as if they're able to sell, one of the key proposals which would be to get rid of some of the non-core business, especially the steel side or some of the businesses.
Okay, I think we lost the line there. Yeah, we did. But I think we got the gist of what you guys are saying. Rahul, great speaking with you. Thank you very much for joining us. And Prakash, as always, it's a pleasure having you with us with that perspective coming through. We'll take a quick break here, but we also spoke with Rahul Arora. I think we don't have that soundbite. We will have that later, but we spoke with him on the Vedanta issue. We'll take a break for now. There's Vedanta, of course, but there's a whole other market which is trading and which is doing very well. 185 points. We're above 19,700. We are back with Jitendra Arora, Executive Vice President, Fund Manager Equity at ICICI Prudential Life Insurance on the other side. Stay tuned.
Welcome back. The Nifty is around 19,700. It's a remarkable rally in the mid-cap index. The mid-cap index is up 1.3%. And now the question everyone's asking is it time again for the banks to outperforming? In the last 3 months, the IT index has outperformed banks by close to about 10%. There you have it. The Nifty IT index is up 10.5%, while the banking index is up less than 1%. So there has been a big outperformance. But after Accenture said what they did and gave an organic revenue guidance of just 0 to 3%, the fear is that IT might start disappointing in terms of the Q2 numbers. Once it starts from 11th of October, we could see some EPS downgrades. So will money start rotating away from IT back into banks? Given what just a reversal of the performance over the last 3 months. So that's about IT versus banks. The other stock on our radar is MCX. That was under pressure earlier this morning after SEBI advised the company to keep the rollout of its new trading platform in abeyance, basically in pause. The stock is off the day's low. Sudarshan is tracking all the latest moves in terms of development. Stock moves, joins in with the details. Sudarshan.
MCX on September 28 announced that it would go live on new technology platform from October 3. Within 24 hours, there was another update in which SEBI asked MCX to put the plan to go live on new technology platform in abeyance. And SEBI cited the reasons of writ petitions filed by Chennai Financial Markets and Accountability before Madras High Court, which has been pending for disposal. Now, in the latest update, SEBI advised MCX to furnish detailed comment on issues with respect to CFMA by October 3. MCX says it will place documents before SEBI Technical Advisory Committee meeting. If we talk about the stock move, MCX recovers after falling up to 9% intraday, while 63 moves is up 5%.
All right, Sudarshan, thanks a lot for that, and thanks for breaking that story as well. For now, the space that's really doing well is auto stocks. Just pull up a couple of them. Tata Motors, Hero MotoCorp are all in the green right now. Remember, in a couple of days from now, you'll get the auto sales for the month of September, and looks like it's going to be a strong showing. Nomura put out a note where they said that the retail sales in September are much stronger than what we'll see same time last year, purely because of a low base of last year, but also the trends have picked up, and the festive season is likely to be quite strong. Prakash Diwan is back with us. Prakash, I wanted your thoughts on Maruti. At 10,600, is the risk reward still favorable for investors? Because, there were a lot of positive brokerage views this week on Maruti. But how's it looking?
Oh, absolutely. I wouldn't have concurred or agreed more. For the simple reason, the festive season is probably timed in such a way for them. It's so favorably timed that they've actually got so many new products that are absolutely available for the taking. Unlike last year, if you recall, Sonia, you had a huge demand, there was waiting, people lost interest, and nothing really panned out of the festive season. But this time around, I think they've geared up in a much more better way. Their showroom presence is so significantly richer. The other thing that's going to happen is that finally the acceptance of hybrid vehicles, thanks to some of the Toyota products and some of the Maruti products as well, is so high that people are willing to pay that extra bit if you're buying into a hybrid vehicle and not just a EV vehicle. So this whole thing of hybrids making their comeback or making a presence felt will probably be seen this season from October to December. I'm not saying I would be surprised if these numbers actually start indicating a very different trend. So absolutely bullish on Maruti. It's always done its job well in terms of restructuring itself, resetting itself, and this is a better time. No better time than this to do it for them at this point.
I just want to set the expectations right. In Maruti's numbers this time in the month of September are not expected to be great. It's a 6% growth that Nomura has forecasted for Maruti. So it's still low single-digit growth, and the management has, spoken about how the entry-level and affordable car segment is still quite on the weaker side. So just want to put that on board and not raise expectations too much. Yeah, go ahead.
No. So I just want to add, the September numbers are already done and dusted.
They're backdated, yes.
But I'm talking about the festive season onwards, October onwards, where things will look up because of the kind of high-price SUV, models that they have, which will start taking some sort of a center stage.
Okay. Let's also get chatting about Navin Fluorine. because that stock has hit a 52-week low. The news is Managing Director and CEO Radhesh R. Welling has stepped down. Sonal joins us for more on that. Sonal?
Thank you so much for that. Well, it has come in as a surprise, and that's the reason the stock is lower in trade today. The MD and CEO of Navin Fluorine, he has resigned with effect from 15 December. He was instrumental in steering the growth that we've seen in the company in the last couple of years. In the interim, we will have Vishad Mafatlal, who will be joining the operations of the company. Now, when I say he was instrumental in steering the growth of the company, just take a look at the numbers as well. Revenues have grown to 2,100 crore rupees in FY23 versus 900 crores in FY18. Profits accordingly have also increased to around 400 crore rupees versus 180 crores in FY18. It was him who steered a lot of these capex plans as well. There was a pause, and after that, he introduced a lot of capex in the company. 1,700 to 1,800 crore rupees is what the company plans in this and the next calendar year. In Q1, when the sector across the globe was facing a lot of headwinds, Navin Fluorine did well. In fact, they said they're not seeing any impact of inventory destocking. They've identified several late-stage opportunities in CDMO when the demand was weak, and also their FY25 growth targets were in place at a time when the other companies were cutting their growth guidance. But the other worry has been the fact that there have been some top-level exits at Navin Fluorine recently. In August, the CEO of CDMO business had resigned, and the CDMO business operations head was promoted as the interim CEO there. In July of last year, the CFO of the company had resigned, and there was a new CFO in Feb 2023 for the company, Mr. Anish Ganatra. Now, Morgan Stanley has an overweight rating, but they say they expect to hear more from the company on how it plans to tackle these top-level exits. Citi says that it will create some uncertainty in the near term. They await any clarity on changes in terms of strategy and other ways as well. But long-term tailwinds, they are intact because of the industry that the company works with as well. But do note that promoters just hold 28%. There are a lot of institutions which are invested in the stock. Mutual funds have around 20.5% stake. There are AIFs, domestic institutions at around 4%. FPIs hold 18% in the company. So there is a lot of institutional shareholding in the company as well. In terms of valuations, commanded a premium versus its peers at 35.2 times FY25 EPS. So yes, there's some uncertainty, and that's the reason the stock is lower in trade. Okay, thanks a lot for that. Well, Prakash, I wanted your thoughts here. The stock is at a 52-week low, but this is a stock in its heydays. It used to be the darling of investors, right? And it has in the past given great returns to shareholders as well. Of course, recently, because of this slew of exits, the stock is under pressure. But what do you do if you're a long-term holder in Navin Fluorine?
Sonia, the interesting part of the stock's history has been when they discovered some of the, uniquely synthesized molecules in the fluorochemical space. That was a clear path or a runway to growth where they capitalized it beautifully. So that's exactly where the peak shareholder returns emerged. After that, what's happened is the markets become much more competitive. So for the first 5 years, they actually had nobody to compete with. They were getting pricing power. Everything was working in their favor. But now if you see the kind of competition that's there, any of these exits which derails the strategy or slows it down is going to have a significantly higher impact. So it gets amplified when you have people at the top who are actually growing the business, no more running the business in a competitive environment. So I would believe it will probably not get back to its glory days in terms of valuation and earnings growth. You're probably better off diversifying into some of the other chemical names. If you're okay with shifting out of that segment, there are lots of chemical names which are erstwhile leaders, but the stocks have not done well or have probably consolidated like Aarti Industries or something. Of course, as I said, if you're okay shifting out of the segment, if you want to be within the segment, maybe an SRF gives you a far better comfort in terms of valuation and business model.
Okay, all right. Thanks very much, Prakash, for joining us. Good speaking with you. Have a good weekend, long weekend, and we'll see you back on Tuesday. Jitendra Arora is Executive Vice President, Fund Manager, Equity at ICICI Pru Life Insurance. He's joining us. Jitendra, good to have you with us here. Thank you very much for your time. The one space which continues to attract a fair bit of attention from both investors and sell side is banks. But it's the kind of attention which is not leading to any significant outperformance, yes, as of yet. Everyone is talking about it, but I'm not sure who's buying it because I guess everyone owns it. What's the way out and what's the road ahead in that sense, Jitendra, for the space? I'm talking about the top 2-3 private sector banks.
Yeah. Good afternoon, Prashant. It's good to be here. So if we see, I think as you mentioned, the reason is that since everybody owns it, and if you look at the nature of the incremental flows, especially on the MF side, if you see, most of the flows have been concentrated in the mid-cap and small-cap stocks or funds. So obviously, the reason to buy large banks there will be very limited. And as a result, we've seen that the sector has not attracted flows per se of late. Add to that, there are other reasons also, like, for instance, the couple of larger names like HDFC Bank and ICICI Bank, they are nearly approaching 10% limit, which as an investor, a lot of us can hold as part of any of our schemes, which is also perhaps acting as a constraint in terms of further buying, which is likely to happen in some of these names. But if I look at the overall attractiveness for the sector, I still find it one of the most attractive sectors within the space. If I take into account the long-term growth potential, the ROEs, the quality of franchise, and also the earnings growth and valuation which these franchises are available at. It's like you're getting good mid-teens ROEs with mid-teens growth potential at mid-teens valuation. I think that's a very, very attractive proposition for a long-term investor. So we continue to like large banks, and we are definitely holding a buy recommendation there, or we remain placed very favorably there.
Jitendra, afternoon. Rima here. You want to quickly tell us, walk us through your portfolio construct, which would be the big overweights, where are you underweight currently, and if you've done any portfolio churn in the last 3 months?
So not too much of a churn in the last 3 months, Rima. But if you see in terms of overweight, obviously financials are one overweight sector in our portfolio. We also like autos, though we are playing more through the ANCs rather than the OEMs there. We also like some of the consumption names, though at this point in time they are beaten down. But we expect that as we turn the quarter and in Q3, we are likely to see resurgence there, or some kind of a beat demand there. And that's where I think we'll start looking at these stocks performing. In terms of our underweight, obviously IT sector remains one of the underweight for us as a house. And again, I've said in the past also that what we have seen is essentially that the earnings have not bottomed out there in terms of the sequential flows. And yesterday's Accenture commentary again defends that view for us, especially given the very weak outlook which they have given. It also has implications for the IT sector for here as well. And if you look at the valuations, they're already at 15 to 20% premium to the historical averages, long-term averages for the sector. So that's one sector we are underweight at this point in time.
All right. Well, Jitendra, we are heading into the Cricket World Cup, right? And there's, of course, a frenzy in terms of whether you talk about hotel bookings, flights, everything seems to be full. Ad rates are surging as well. So I wanted your thoughts on a couple of these pockets of consumption. One is the QSR stocks, where you have the Jubilants, Westlifes, Zomatos of the world, the platform companies, which have done very well up until now. And the other is the hotel stocks, like Lemon Tree, Indian Hotel, Chalet, all up about 30 to 60%. Have investors missed the bus, or do you think there's more to go for some of these stories?
For some of these stories, obviously, there is a much bigger long-term runway for growth, Sonia. So, for instance, talking about QSR, if you see the frequency at which Indians will be eating outside will be still one of the lowest across the world. And also the sheer amount of distribution expansion which some of these names can undergo is still very large. So the opportunity there is pretty large in my view, and it's a multi-year opportunity. Obviously, you can take a look at the valuations from time to time and decide where you want to be present in. But QSR as a space, we definitely like as a house, and we have a reasonable overweight on that space as well if you go through our portfolios. Hotels also, they've done very well over the last few years. However, we think that, again, the valuations there are now on the higher side compared to the historical averages. And we may see some kind of consolidation now, especially when we see that some of the near-term triggers, like what happened in terms of travel post-COVID, the World Cup, the G20, all these demand triggers go away. And then we are back to the normal situation.
Jitendra, burgers over pizzas?
I think that's the consensus for everyone.
But why is that? Actually, I'm asking, why is that? I mean, it's not. I'm not sure it is taste tests or anything, but is it down trading? Because I mean, because of inflationary impact. I mean, people, it's affordability. Yeah.
It's not really that, because if you see the offerings for a pizza, we have a pizza starting at $70 compared to a burger which perhaps starts at $40-50. The price differential is not that great, Prashant, in my view. I think what's happened is perhaps given the familiarity with pizza space, or the expansion on the pizza space has happened much earlier for us as a country compared to, let's say, burger, which is happening now.
Okay.
So when you said your overweight consumption, clearly QSR is one theme that you like. Hotels, you believe that they're in for some consolidation. We may not see that big upside like we've seen in the last couple of months. What about your traditional staples, the FMCG names? This quarter, we're likely to see some margin tailwinds. But where do you stand on FMCG?
So as a house, we have a very neutral kind of position on the sector per se. What we like about the sector is the kind of stability it provides to the overall portfolio and the diversification it helps us achieve. It's a sector where we believe that the earnings growth will be on the low double-digit side over a longer term. So whenever you are at a valuation point where you see that they start becoming attractive, you try to get into the sector and then rotate out of it when the valuations start pricing in a lot. So right now we see that the valuation of the sector are drifting towards a attractive point, and I think maybe another quarter or two of underperformance, and then we may see that we will perhaps try and see if we want to add a bit more on this side.
Okay, since you guys are talking about pizzas and burgers, right? What about beverages? I mean, United Spirits, United Breweries, all of that. That's also been surging quite a bit, and we are heading into a long weekend, so I guess everyone has their plans ready. But how are you feeling about that, Jitendra?
So that's one sector, Sonia, where we've had limited position from time to time, and I think it's also to do with the lot of regulatory noise around that sector, which we see from time to time. So clearly, we look for a much higher margin of safety in this sector when we look to invest in.
Okay, all right. We will let you go on that note. Thanks a lot, Jitendra, for joining in and giving us your views. Appreciate your thoughts. By the way, the market looks like it's going to have a very, very strong close today. So contrary to what perhaps when we started off trade, the expectation was that we would be a little bit on the lower side. Of course, there was a little bit of profit taking in the last 10-15 minutes. But otherwise, the market will end handsomely with gains of over 120 points. But let's see, it's getting a bit volatile towards the end of trade. Let us get to our segment, D Street Chatter. Nimesh will get us an insight into what's happening in the dealing rooms, as well as a couple of stocks that are up and about in trade. Nimesh, what are you looking at?
Hi, Sonia. I had a very strong start to the October series, and historically October has been a good month for us. So good going. Technically too, we are above the 19,600, which is a good, important level to watch out for. So even from that sense, it's a good start to the October series. But the big sector of the day is clearly the pharma and the healthcare index. Both the indices are up more than 3%, and I'll tell you a couple of reasons why that entire sector is buzzing in trade today. The first is it's been seen as a best defensive sector now, given that IT could relatively underperform after what we saw with Accenture and the fact that Q2 could be a bit soft for most of the IT names. So that's one reason that there is a bit of shift happening. The second important reason is yesterday HDFC mutual funds, pharma and healthcare fund, NFO got closed. And I understand there was a very strong response. They've raised more than 2,500 crores. So that money will get deployed into that sector in the days to come. So these are a couple of reasons why the entire pharma sector is buzzing in trade today. Apart from that, I guess there is a bit of shortcoming as well in the sectors like metals as well as the financial names. Remember, we are starting the series on a lighter note and that on the short side. So that also is helping the market to pull back from what we saw yesterday. And that's helped the broader markets as well. So after a brief couple of days of reaction on the negative side, a bit of pullback in the broader markets as well, as we've seen the mid-cap index is up more than 1%. And there are a lot of stocks which are buzzing as well in the broader market. So net, a big day for pharma, largely on back of a couple of reasons I explained, and a bit of short covering in financials as well.
By the way, now the Nifty is down nearly 90 points from the day's high. When we started the show, we were above 19,700. And now we're at 19,635. There you have it, in the last 10 minutes. Two stocks. One is Reliance Industries and the other one is HDFC Bank. Both these stocks have come in for some selling pressure. Nimesh, you want to run us through the stocks that you have on your list?
Sure, Rima. So the first stock on my list today is the GMDC. Big mover on that stock and on good volumes as well. Up to 12% last when I checked. I understand there are good volumes at the HNI desk. A lot of HNIs have bought as well. And there is a anticipation of some corporate development in GMDC very soon. So that's the reason why that stock is buzzing in trade. The second stock is IDFC First Bank. For the last few days, that's been consolidating in a very narrow range. I understand the fundraising where QIP is around the corner and can happen very soon. So that's the second one. The third stock is L&T Finance, a big mover in that stock as well, and on good volumes. I understand some FI interest is back in that stock. And remember, this is one stock which is part of that management change as well. We saw recently the CEO change and seeing a bit of uptick in that stock in today's trade. And the last is a couple of cash stocks, which is Devyani as well as Shami Hotels. Shami is, of course, the new listing. Both the stocks are saying very strong buy flows at FIDs. So looks like some institutional interest is back and the delivery volumes are going to be quite high in both these names today.
All right, thanks a lot for that, Nimesh. Let's take a short break and as always get you some buy today, sell tomorrow calls from our technical experts. Stay tuned. Welcome back. We're just counting down to what has been a pretty decent day of trade. We've come off from the highs, definitely, but we'll close also with gains of over 100 points. The thing is, we're heading into a long weekend. We don't know which way the global markets could go. And, you know, global markets have not had a great run in the month of September. So there is a little bit of trepidation on board and some profit taking as well. But this is the CNBC-TV18 exclusive. Sources tell us that TCS is set to withdraw the hybrid working policy. My colleague Yusuf is joining in to give us exclusive details on that. Yusuf, over to you.
Yes, that is right. We learned that TCS is going to withdraw its hybrid working policy, which was introduced way back in 2020. In an internal communication, the company has said its workforce should attend office for 5 days in a week starting October 1. At present, employees need to be in office for only 3 days in a week. The company is yet to respond to an email query from CNBC-TV18 on the matter. It's important to note here that in FY23 annual report, the company had emphasized the importance to return to office. The company said more than half of its workforce was joined post-pandemic and physical interaction with senior leaders are needed for employees. Interestingly, TCS, which sets aside more than half of its revenue to meet its wage bill, had a workforce of more than 6 lakh at the end of FY23. So this move can spell a large number of heading daily to office.
That's been the big trend, right? Calling people back to office. TCS has been maintaining that so many clients visit us, so it's nice to have the employees come back and interact with them. Mayuresh Joshi, head of equity research at William O'Neill, is with us on the show now. Mayuresh, what have you made of Accenture's numbers that were reported yesterday? What does it spell for the Indian IT companies? And are we likely to see EPS downgrades in the upcoming earnings season? And is there any risk to the companies like not meeting their full year guidance that they've given, at least the ones that have?
Afternoon, Rima. Accenture's numbers are a little bit softer than expected, both in terms of the margin guidance that they have given and the expectations in terms of revenue growth in constant currency terms. Having said that, since Accenture mirrors a lot of our IT companies in some terms of the outsourcing model, a lot of the large cap IT companies probably started feeling the heat yesterday. Tech Mahindra case in point, which corrected quite significantly yesterday. Though the opportunities are pretty large structurally over the next few years in terms of AI, cloud computing, and the sheer size is expected to grow at a pace of 15%, 5% in terms of data center growth, 15% CAGR in terms of cloud computing, and in fact, more than 50% in terms of the 5G ecosystem itself. I think the short-term pain points, Rima, are probably here to stay. A large element in terms of the multi-million deals that a few companies like HCL Tech, TCS announced, I think that should largely be a part and parcel of the overall order wins that they were expecting for the better part of this financial year. And if the soft landing situation persists in the US markets, specifically when it comes to the fourth quarter of the quarter one in their context in terms of order firming, specifically large orders, and if they get delayed or deferred by a few quarters, it does pose an upside risk in terms of the revenue guidance for the second half and for the first half of the next financial year as well. Having said that, valuations of large cap IT companies have probably come down to a large extent. Mid-cap IT companies still seem to be outperforming as we speak, both in terms of pricing pressures not being evident from management commentaries and expectations of revenue growth staying extremely stable going forward. The only aspect in terms of valuations being through the roof and late-stage basis for mid-cap IT companies can make it a little bit more susceptible if revenues do not fall in line in terms of market expectations. So we're largely having a market performer call for the sector as well. It will largely depend in terms of how the first set of numbers start turning out and what take the management probably gives us in terms of the macro environment as far as the US and the European markets.
Okay, well, Mayuresh, you know, I wanted your thoughts also on what the way forward could look like in terms of stocks that we should watch out for. Any big triggers that you notice? There's, of course, auto sales that's coming up, so those stocks are in focus. There's the World Cup that's coming up, so there are, of course, all these travel-oriented, you know, platform companies in focus. But where are the stocks where you see both valuation as well as growth comfort?
Afternoon, Sonia. So I think out of the select pockets that we are probably tracking, paper stocks probably looking a little bit more attractive as we speak at this point of time. If you probably look at the construct of the sector as a whole, the deficiency in rains will probably drive out a lot of unorganized players who are largely dependent for their water needs in terms of the natural rainfall or the resources that they are dependent on, and even the power needs. So the integrated players within this vertical itself can benefit quite significantly. Players like a West Coast, Andhra, JK should have significant accretion. Festive season coming around, so a lot of demand in terms of packaging boards, specialty paper, writing paper. And therefore, I think that the expectations in terms of price hikes coming through, and a large part of these price hikes, even if these companies take for the industry or the sector as a whole, because input costs will be minimal because of their vertically integrated operations, the performance in terms of numbers will be relatively better. They've had a stellar show last year. Our expectation is that it should probably continue as we head into the next few quarters as well. Auto ancillary, Sonia, a space that you closely track, also should continue doing well. I think the entire theme that we are speaking about in terms of the EV ecosystem transition, a lot of players are going to be key beneficiaries in the next few quarters. Rollout across products platforms expected by a lot of OEMs across two-wheelers, four-wheelers, and even the commercial side in the next few quarters as we speak. And therefore, auto ancillaries, which are transitioning to this part quite successfully over the last few quarters, should continue doing well. So our take is that stocks like PM Industries, as an example, remain on our buy watch list. Excellent product profile that they probably have, excellent margin profile as well, and the expectations of a very stable growth going forward will probably mean that this company stays instead. Even the battery makers, something like an Amara or an Exide, should continue doing well because of the additional capacities they are probably building up. Something like a Minda Industries as well, which has done well, somebody can definitely hold on to this stock. And therefore, auto ancs and paper stocks as a space look interesting from a growth and a value perspective.
You know, we had a chat with JK Paper just about 10 days back, and they get about 40% of their revenues from the office paper, the supplies that you need. And they said that the office paper demand is very strong. It's back to pre-COVID level. And the recent news flow, like TCS calling all their employees back to office, is only going to boost the office paper segment demand. So auto ads and paper, that's what Mayuresh likes. Get into a break. We'll come back, and 8 minutes left for closing this day and this week.
Okay, 5 minutes to go for close. We are just 100 points up. We were up almost 200. So there's been a significant give back which has happened. Mayuresh is still with us. Mayuresh, RR Kabil, I don't know if you have looked at that name, cable and wire company, exposure to the FMEG segment as well, fans and other electrical goods. Now trades at, I was just looking at the numbers, it trades at 80 times, no less. When it came to the market, it came at a premium as compared to your Havells or a KEI or others. And over the last 2 days, yesterday was a big day, today is a bigger day. It's now gone up to almost 80 times. FY24 earnings, by the way. Your thoughts?
Afternoon, Prashant. No, absolutely. I think the move that the RR Cable has over the last few days has been exponential, to say the least. And therefore, valuations have definitely gone through the roof. In fact, even all its peers within the wires and cable space, look at the sheer outperformance that stocks like Polycab have done over the past few months. Obviously, numbers that came in the past quarter have been exceptionally good. The commentary surrounding the entire space itself is very, very encouraging, both in terms of housing demand and the expectations in terms of a lot of export opportunities that can come their way. The KEI management as well sounded very, very optimistic on both these counts. And therefore, volume/value growth was expected to continue at a very reasonable pace over the next few years. So I think most companies within the space itself, KEI, Polycab, RR Kabil, have probably shot themselves up as far as price action is concerned. Valuations are through the roof, trading at late stage basis as we see at MarketSmith, and therefore pullbacks on stock like a KEI, Polycab, even an APAR, for example. I think an exceptional move there as well is definitely warranted. No fresh investments at these levels. Pullback is the only way that you can probably look at this.
Mayuresh, thank you very much for joining in. Enjoy your long weekend. For the markets, this last 1 hour sell-off took some of the sparkle away. It would have turned out to be a very strong session for our markets, with the Nifty closing well above 19,700. But by the close of trade, it's still a good session, a 100-point rally on the Nifty, but we're off close to about 100 points from the top. Up 0.5% on the benchmark indices. The mid-caps fared well. The mid-cap index was up nearly 1%. Advanced decline ratio at 2 stocks in the green for 1 in the red. The gainers include Hindalco. We saw the dollar index recede over the last 2 days. So metals have done well. So NTPC higher in trade. Pharma. The Nifty Pharma Index was the top sectoral gainer. So names like Dr. Reddy's, Divi's, Sun Pharma up between 2.5% to 3%. Hero MotoCorp saw some buying ahead of the auto sales numbers for the month of September, which will come in over the weekend. Losers were largely IT, LTI Mindtree, Infosys, HCL Tech down over 0.5%, and Adani Enterprises took quite the knock, 2.5% down.
Okay, well, lots of individual stocks, even in the broader markets, which are doing, have ended in the green. So mid-cap index up almost about 450 odd points. Easy Trip came in for some profit taking today, so down about 3.5% there. Ujjivan Small Finance Bank has had a very strong rally all of this year, but today Ujjivan Small Finance Bank was down about 1.5%. Dish TV, Power Grid, a couple of other stocks that ended in the red. But on the upside, a lot of banks ended in the green today. So whether it's RBL Bank, Union, South Indian Bank, etc., PFC, REC, Central Bank of India. So a lot of financials and, these power finance companies did well. Zomato, we are heading into the, Cricket World Cup. So perhaps there'll be going to be a lot of work for these platform companies. So Zomato up almost about 1.5%. Zomato's rallied 50% this year already. So big mover coming in over there. And a couple of other names like Punjab National Bank, etc., ended in the green. But by and large, given everything, given all the cues that we had, it's not such a bad end to the day and the week.
No, it is not, absolutely. And, let's just hopefully come back after this long weekend to a Tuesday with the US government still functioning, right? And then I think we can pick up from there. By the way, just levels, right, on both the Nifty and the Bank Nifty, the levels we put out in the morning, actually the market's ending exactly at those levels. So it's neither here nor there. So the 40-day exponential moving average for the Nifty was 19,624. After the sell down we've seen in the last 60 minutes, we're leaving off at 19,635. So it's pretty close. And the Bank Nifty, the 20-week moving average is at 44,570. And we are at 44,590-ish on the Nifty Bank, 96. So pretty close. And I think we'll get the adjusted rates in a bit from now. So, can't say with certainty. It's not a very strong close above these levels, and these are just levels we need to stay above for the market to find direction higher. It's a wrap on this edition of Closing Bell from all of us here. It's thank you, goodbye, have a fantastic weekend. It's a long one, but on the other side, stay tuned. Our special show, Smart Money, will take all the action forward.